So it's interesting that as our growth index has been falling and it's kind of teetering, growth isn't where it used to be. Uh, the market is just kind of stagnating now. We haven't really gone anywhere in the last 2 weeks.
Yeah, and it's obvious, it's pretty apparent, right? Like we look at what's going on here. Overall, we had real GDP come in this week at the estimates at 1.4%. So it's still positive, right? But it's just not obviously not as hot as one would have expected just a few months ago, but it's still positive. So we can't discount that completely. I do think, however, like you just said, right? Like our growth index is slowly picking up on some shifts under the surface, and some of those things are being presented in data in some economic data at this point. Now, again, our growth index is going to be more high frequency, right? So some of the stuff we're seeing now, and if we take a look at real wages are still positive and they're still above the longer term trend. And for those that don't know what I am talking about here, with what this is, we are dropping a new product this weekend. It's called our macro deck, and it's going to be released once a month at the end of every month. And it's going to have a summary of a refresh summary of all the most important charts for a wide range of economies that you can track and keep note of and see how things are progressing under the surface.
And
So,
and the
as I just said,
goal, something I want to note too, is the goal with this macro deck is um, providing data that you can't really find anywhere else, especially not for free. So this data is going to be things that we look at and things that we find important that you're not really going to find anywhere else. And we do have a bit of a summary under each chart, and we're going to send this out with an email. And in that email, we're also going to pick out a few charts that we think are important currently, based on what they're doing and what they're telling us. And we'll have a little breakdown on what they're telling us and what we think it means for the overall stock market and bond market, and how it kind of ties into our system and our portfolio allocation models. So that's the goal with this, is to kind of give you guys something that you haven't really seen before and a little guide on how to use it as well.
right. And this goes, let's go back to the real wages here, right? So ultimately, real wages are growing above trend still, but barely, and they're still in positive territory. So that's one positive sign that we're seeing. So inflation adjusted wages are actually going up, right? And that's something that I think what you were saying earlier, like the growth index is weakening under the surface, and now we're starting to see some of the data points come in. For example, if we take a look at real retail sales, that's still negative. So, inflation, adjusting retail sales for inflation, we're in negative. We're basically declining, right? We're deflating. And then, if you would adjust industrial production for inflation, you're barely positive and you're still under trend. So obviously, when people out there, I'm sure you've seen it too, right? Everyone on X is saying, or not everyone, but there's a lot of people, there's a good part of the macro society that thinks the Fed is not restricted. And I think that if you really look at what's going on, not the meme coins, not the meme stocks, none of that nonsense, you look at like just overall data, it's apparent that the Fed has done something, right? I mean, I'm not showing you guys charts here of things that are just blasting out across all time highs or aggressively growing, right? Like everything's pretty much flatlining. And obviously, this has all come after the Fed has raised interest rates aggressively from zero. So there's obviously effects here that are bleeding into the market. Our compound landing theory is still running its course. And I really just want to see how we progress from here. Do we get that shift into negative growth territory, or do we just hang on for dear life, get that more optimistical slowdown in the economy, not recession, and then after a quarter or so, some sort of reacceleration? That would be the most optimistic outcome. Obviously, the most pessimistic outcome is we go right into a shallow, maybe even deeper recession, which I don't think anybody really wants to see a recession. You don't want significant impacts in the labor market. You don't want to see all these negative implications for families and people. but that is part of the economic cycle. It does happen, so we have to respect it when it does, and we have to just kind of ride the waves as they
and
progress.
and the thing that really separates that optimistic outcome and the pessimistic outcome comes down to the Fed. If we
Yeah,
start getting this growth slow down and then we get that rebound, when we get that rebound, where is the Fed at? Have they already panic cut and are way too low, and then now we get another inflation wave? Or the opposite, if it just growth just keeps slowing further and further and the Fed is not doing anything about it, it's going to be a much harder landing. So it really comes down
right.
to the Fed and how delayed the response is going to be.
I completely agree with you there. I mean, this is a game of um, preventing an overreaction, and I don't know. Some will argue that the Fed should be raising rates. I think that's a grave mistake. I think we've been very clear about that. I don't think the Fed needs to raise rates any more than where they are right now. And if anything, I believe that they should have already started the cutting cycle, right? I think we've said that multiple times now. Um, and at this point, the only question is going to be, at what point do they realize that they should have started cutting if they don't cut soon? And I don't know if they don't really cut soon here. I think the risk starts getting it starts pretty much rising considerably as time goes on that they are going to overstay their welcome in restricted territory. But right now, we're kind of just lollying around here, and everything seems to be okay on the surface. But as we just went over a few data points in terms of the consumer, things aren't the best, and I mean even the industrial sector, it could be better, but it's not really falling apart just yet.
Well,
And
it looks like the labor market supply rate has been coming down pretty quickly. I wonder if that's going to continue. I think that would be a problem if it continues at this rate and we dip below one job opening per unemployed person. That's when we're really going to start to see the job market get hit and unemployment potentially start rising faster than what the Fed is even expecting.
yeah, I do think that's obviously a possibility. I mean, look, ever since the Fed started raised interest rates from zero, the labor supply rate has been getting pretty much whacked, right? I mean, we were probably up near, I would say 2% roughly. Excuse me, two job openings for every unemployed person, and since the Fed has raised interest rates, we're down to 1.25. So things are taking a hit there. And I think that maybe we have to see a little bit more excess pulled out of here before we start to see a real acceleration in unemployment itself. But this obviously opens the door for what happens when the Fed does cut interest rates, right? What really happens then? And I think we should have a good conversation about that because it's a very interesting dynamic if you have a slowdown and not a recession. So um, the base of this conversation really lies in small caps, right? So if we take a look at IWM is still about, I mean, I think it's 15% or so. Let's see, about 14% off its all time highs, the 2021 highs, right? And obviously the Nasdaq S&P 500 much higher, doing phenomenal, those two indices, whereas the small caps are lagging. Now the thing that you have to understand with small caps, right? In this case, the Russell 2000. This is 2,000 stocks, most of which are not valuable companies in terms of cash producing, um, positive interest rate environment friendly companies, right? They're companies that are high growth, burning a lot of cash, some zombies, right? Not really the best quality companies. So when you have rates go up the way that they did, you have a basically an aggregation of capital into companies that are doing well, which is why you see the mags. The reason the mag 7 is plastered everywhere or and has been for the last 6 to 12 months is because each of those companies are cash producing machines, right? So in an era of high interest rates, which is what we're in right now, I don't even know if I'd call it an era, but this period, right? We are seeing capital get pushed up to things that are you're almost guaranteed growth in the Mag 7. I don't want to say every company. We could look at a company like Tesla, right? But in terms of um, positive returns on investment, like the companies aren't burning cash and without producing any bottom line income, right? That's really what's going on here. And I think that what you saw was, like I said, an aggregation of capital out of small caps. So think of like all this cash leaving the Russell 2000, right? These 2000 companies getting forced into what we call the NASDAQ 100, the S&P 500. Now, when rates come down and you have this slowdown, but not a recession, the question you have to ask yourself is, well, does policy come in enough to almost boost the appetite with that lower risk-free rate for more speculation in terms of these smaller cap companies, in turn giving some life to the small cap sector? Because that's a possibility if you do not have a recession, right? So I think that that's really where we need to put our focus at right now until we really see growth shift negative. After which, then obviously the fear of recession is the most dominant fear. Right now, I think we're in slowdown territory. And until we leave that territory, I think that there is a possibility for some favorable outcomes on a reacceleration to the upside in terms of small caps. Right now, we don't trade small caps individually or even aggregate, through indices. But I think that you have to keep this in mind, right? People automatically they look at the Nasdaq, right? So we'll take QQQ, and they're like, "Oh my gosh, if rates come down, this thing is gonna skyrocket," right? And that's very well possible. But I think you also have to take into some consideration that that aggregation of capital into these names is because rates are high, right? People are forced to chase companies that are of super high quality when the risk-free rate is lifted so aggressively. So if that goes down, do you see more dispersion of capital across more of the market, which obviously would be more of a rotational thing? I mean, we have Druckenmiller out here with IWM calls, right? So there's obviously some appetite for small caps given the idea of an easing Fed and possibly no recession at the moment. Now that again is the no recession part is the most interesting part, because if growth does start fading and clean out into negative territory, then all bets are off. And obviously at that point, it's everything becomes correlated. Everything's correlated to one, right? Everything goes down at once. And you're pretty much really left with bonds and dollars as a outperforming asset in an environment where everything is correlated to the downside
So
with the Fed having.
what would be the optimal pivot point if someone's looking to rotate out of the Nasdaq and into small caps? What's the ideal pivot point? Is it when the Fed starts cutting? So once the Fed does one cut, that's when you want to rotate? Or is there kind of a point like maybe once they get down to 2%, that's when you want to start rotating? What
No,
what is a way to
I
look at
think
it?
I think the market's forward looking enough to the point where if the Fed starts cutting, and the market for front runs the Fed remotely in an accurate fashion, small caps are going to do well, given they are cutting to bring real rates in balance and not to aggressively stimulate.
Well,
And what I mean by that
what
is,
if they're cutting and futures are pricing in one cut every second or third meeting for the next year or two? Is that
I think
enough
that
to stimulate small caps?
I mean, we're already there in terms of what, like two interest rate cuts by the end of this year, right? So, um, ideally, we'd have to see more consistency from the Fed. I think rates are a little too high to make small caps favorable at the moment, and I think that's pretty much why we have seen them do absolutely nothing, right? Pretty much going sideways since all year. And at first, we had this ramp off the lows when we were expecting six cuts. And obviously, we didn't get six cuts, but small caps held up decently. They didn't really unload to the downside. They've been holding this bullish trend run this entire year, and we're just above Momo now. So I think if rate cuts expectations do come in, they're somewhat consistent. And when I say consistent, I want to go to your point. Like one cut every other meeting, yeah, I think that would be a good start. But like this whole one cut, sit back, wait and see, and don't do anything for 3 or 4 meetings, like I don't think that's going to bode well. But I don't think the Fed's in a position to really play that game. That's a game that should have been played 6 to 12 months ago, right? Like them doing this one cut, we'll wait and see 6 months. Like I don't think they're in a position to start doing that. I mean, again, it's not like this economic data is coming in piping hot, right? On an inflation adjusted basis. And some of you will say, well, let's look at retail sales, right? Retail sales are negative 1%. okay, so that means if inflation's at 3, that means retail sales are running roughly 4 or 5. So 5% nominal retail sales are phenomenal. It's inflation that's the problem. If inflation comes down, this number comes back up, right? Because then you have a lower, you're subtracting a smaller number from the nominal figure. So you're getting better retail sales without actually having to, or I should say, better adjusted retail sales, right? And I think the problem there is you guys have to understand that 3% inflation, like we're not talking about, it's not like this is -1 because nominal is 9 and inflation is 8, right? Inflation is 3. And over the like pre-COVID, inflation was like 1.8, 2%, right? 1.5 in that range, right? So what do you're doubling trend and you're going to claim that like the economic situation is really destroyed by inflation when in reality nominal is up there but it's been trending down, right? Because inflation has pretty much gotten cut in half, more than cut in half in the last 12 months, right? Or last 18 months I should say. But real retail sales, for example, have been negative or sideways for some time now. So that smash in inflation hasn't really helped this, which again is telling you that the Fed is in a position right now where if they let this go on further and longer, what's going to happen is these numbers are going to start to weaken more and more and get progressively worse or negative, right? I mean, again, we're seeing a lot of numbers. The only thing that's really looking well right now is real wages, and they're just above trend barely, right? Everything else is moderately under trend and or negative. So I think that there's obviously something going on here. And the longer the Fed waits this out, basically just because inflation had some short-term volatility the last quarter or so, they should have started cutting already. And I think they realized that. But they're going to play this game because they don't want to make a mistake. And that hiccup from inflation volatility may cost them possibly um, the ability to avoid stage 4 of the compound landing. I think that now we're at a junction where they really don't have much left here, not much meat on the bone, but the Fed has done more miraculous things than this. So maybe they can pull it off. That's just me, the optimist in me. But I think ultimately, if we don't start bringing rates down soon and with some consistent manner, you're going to get a degradation across the economy that's going to be more persistent than what we're seeing right now. And then that slowdown turns into a recession, or I should say that slowdown turns into a drawdown, right? The slowdown is more like a bellowing out. Everything's looking okay, moderating, not the best, but then you get that reacceleration, lifting everything. Everyone's like, okay, it was just a hiccup. Whereas I think the Fed's really the playing with fire here, and I do agree. I tend to agree with this notion that they made a mistake at the last FOMC meeting in terms of addressing the outlook of inflation. They basically, in the dots, they forecasted a higher inflation rate, right? But at the same time, they basically forecasted unemployment not changing, right, throughout the rest of 2025, barely changing. And we already see the labor supply rates getting smashed. So it's only a matter of time before this picks up in unemployment, right? And at that point, how fast does it take for unemployment to lift how fast does it take the Fed to react when unemployment starts creeping up, 10, 15 basis 10 to 20 basis points at every monthly print? At what point then is like, oh gosh, we made a mistake, right? And I think that's where we are right now. Unemployment's roughly at 4%. So it's only a matter of time here playing this out. And I think if the Fed does react, maybe they react with some confidence. They really soothe the forward expectations and maybe save some of it. But as you guys know, our compound landing theory is pretty simple. There's 4 stages. We're in stage 3. Stage 4 is the typical recession, and this is very particular to this environment. The compound landing doesn't work in the GFC, doesn't work in the dot-com bubble, it doesn't work in the slowdown pre-COVID in 2018. This is a very specific to this cycle, right, where everything gets lifted up. But I do want to bring this back to what you're looking at, right? What are you seeing in bonds? I know bonds are bullish trend, but what are you feeling when you look at this?
I'm bullish. I'm bullish bonds. I think it's only a matter of time till our system even becomes bullish bonds as well. It is bullish trend now. And as we say, bullish trends tend to lead to higher prices. And we are starting to see the slowdown bleed into different parts of the economy, and I think these bonds are definitely picking up those signs. So I think it's only a matter of time unless we really start seeing growth pick up again and start seeing some hot growth numbers come out again. I think bonds are going to continue higher or at least chop in this area. I don't think there is a point in shorting bonds. That's definitely not the trade at the moment.
Yeah, so I guess the whole inflation going the 1980s repeat is out the window, right? At this point in time.
Yeah, totally.
Yeah,
I
yeah.
don't see what could reignite inflation, especially at this level of tightness. I mean, the only way inflation would get reignited is if the Fed just panic cuts for no reason. That's the only thing that I could see
And
it
you're saying
happening.
aggressively though, right? Like they have to really like panic
Yeah,
cutting
like
like
aggressively, not just one
well,
cut. I'm talking like
I
they cut
I guess that's not panicking.
by 1% in the span of
Yeah.
like 2 meetings.
I guess that's yeah, one I that was a blunder right there because when the Fed panic cuts, they're not cutting by one time, right? So
Yeah.
they're it would a panic cut by definition is aggressive. So I think that you're right in that sense. I think that the like I'm sure you're seeing it too that the system is slowly inching towards risk off, but it's like not there yet. But it's definitely giving us more clearer and clearer signals by the week. I mean, we have obviously managed risk appropriately the last few weeks, and or month, right? Not the I don't want to say it's perfect. No, there's no real perfect model out there, but in terms of riding the coattails of what we're seeing right now and taking risk off the table, I think we've done a phenomenal job.
Yeah.
You guys are going to see the RQF summary depending on when you listen to this Friday after the bell. As usual, it's going to be end of quarter, end of month. So we're going to have a little RQF rebalance into the close, and then I'll post the stats after the bell. And we're doing pretty well so far this year. We're we're over 20% returns.
Yeah, last month we
Obviously,
were just barely doubling the S&P's performance for the year.
yeah,
And so we'll see where we stand at the end of this month. But we're
yeah,
still generating quite a bit of alpha, which is nice to see. It's nice
yeah.
to see the work pay off.
Especially when the waters are muddied like this and everyone seems to be fighting over the top being in and not being in and you know things turning at any moment here and it's not just them, right? Like it's pretty evident that there is some softness in the economy, so things are obviously shifting. Not only can we see that visually with some of the charts we just showed, but our system is indicating something quite similar. So obviously things are getting softer, and the question is now, as always, does the Fed react ahead of it or in line with it, or do they wait until it's too late? And I think that's where the compound landing will ultimately take us. But we have to take this day by day, trade by trade. We're going to just watch and progressively move capital as the signals appear. And right now, I do agree with you. I mean, look, the bonds are bullish trend. The system is inching towards, grinding towards that bond trade, but we're not there yet. And I think that if we do get it, and it aligns with a more material slowdown in the economy, it'll be a powerful trade, especially depending on this. You know, it's going to really depend on the severity of the slowdown and how aggressive the Fed's going to attack it. But I do think that it has the potential to be a powerful trade. But until we really get that slowdown, I do think the bond trade is somewhat capped to a degree, right?
Yeah.
Because ultimately, the Fed is going to have to really show their openness to ease and reduce the interest rates. Otherwise, the bond trade is, you know, it's going to have one of those pumps and then like kind of like this, right? Where we get the six cuts being priced in and then a bleed out. Like we could see something like that
Yeah.
where
Well,
the first rate cut.
the difference from this scenario versus what we saw in early 2024, that bullish trend that we got in TLT, growth was strong. It was very strong back
That's
then.
true.
And so that's why we didn't long bonds. It just we didn't see that slowdown that bonds were picking up and all of those cuts that were being priced in. We were talking in podcasts back then saying that we don't believe that these cuts are going to happen, and sure enough they didn't. And but now we're in a very different situation, and I actually think the market it might even not be pricing in enough cuts based on the growth slowdown that we're starting to see.
Interesting. Yeah, I do think that there's that like we just said a few minutes ago. I think you're right on that sense that there's obviously a slowdown, but I do want to take the stance that I think we need to see some of that edginess in the market of between um, risk on and risk off dissipate and market really pick a direction, specifically risk off, right? Negative growth environment for bonds to start excelling because again, the Fed cutting interest rates by 50 basis points or 100 basis points, I don't think that's going to give the bond trade life, the life that we're all looking for, right? I think we're looking for like the Fed to really bring rates sub 3% to ignite like a really powerful move. And to your point, I do think the Fed should have already started cutting, but I also think that maybe we end up with a fragmented bond trade, something where like there's a bond trade for 3 to 6 months or whatever, a quarter or so, quarter and a half, where the Fed's reducing rates and the market's kind of getting ahead of itself, and then the Fed hits like a pause area that bonds pull back, right? They price in too much, and we have to rotate capital between bonds and or stocks if that halt in policy shifts to the downside doesn't coincide with a real recession. It's the idea is that the Fed just had to bring rates back into line without like an actual recession. Therefore, stocks continue to get the bid. There's a bunch of dynamics here that take place. I think we have to take it
Yeah,
day
all
by
I
day.
know is the market's not going to make it easy for us.
It never does. It
It's
never
it
does.
never makes it easy for us. It's always going to be a fight. These last 2 years have been a huge fight. It's been murky waters constantly. Honestly, I think we had just a few months of non-murky waters when we were along the Nasdaq riding this wave up recently where growth was
I
just strong, and it wasn't an easy trade. There was a lot of hate when we first uh, longed equities, and it was difficult coming out of the scenario that we had. It wasn't an easy long, thinking how could growth be strong during this time, and that's what a lot of people were thinking back then. But we just trusted the system, and eventually it did become obvious. Like, yeah, growth is strong, and we are in the right trade. But it didn't make it easy even then, and I know for a fact that the bond trade is going to be the same thing. It's not going to be easy. And when we long bonds, there's going to be a lot of people out there telling us that we're wrong. And it's not going to be an easy trade. We might be wrong. Who knows? Everyone's wrong. But hopefully we're not.
Yeah, I don't I think based on how we've been doing things so far, right, with our system and whatnot, it's going to come down to just that timing aspect, right? Like I do think, like I just said, and I like going to your point of it being a hard, not being easy, being quite hard. I think that's what it's going to be, right? I don't think we're going to get this straight. So I think everyone is looking for the bond trade to look like 2018 and going into COVID. I think people are thinking this is what the bond trade's going to look like, and I think that that's a mistake
I mean, I
because
hope that's what the bond trade looks like, but I
I,
know
I
it's not
hope
going to be.
I hope so too because it's just one of the dumbest, easiest leverageable longs in your life, right? Like everything's going to shit. The Fed's cutting interest rates, right? And you just know it's just an easy trade. Um, I just don't think the velocity of this trade is going to be the same. Obviously, look, we hit the pandemic, rates went down to zero, right? Like, I don't know if this slowdown is going to bring rates down to zero. I don't think so.
I don't think
I
so
really
either.
don't think so. So
This is going to be a slowdown induced by the Fed, whereas that was not a slowdown induced by a Fed.
right. So I think we're going to be pretty much left with this stagnated bond environment, right? Where we get maybe this strong bull leg, a good longable leg, and then some consolidation, maybe a little bit of a drawdown, and then another one as these cuts come into fruition. But until that really happens, we have to trade what's in front of us. Right now, we're not in risk off just yet. And for those that are wondering, you can track all of this on a daily basis through our Quant Deck product. It is our intraday, or I should say, our daily summary based on the intraday updates in our macro systems. We put everything together into one simple report where you can get signals, you can get quick summaries, and you can see really what's going on in the markets. This is how we position our accounts. That's how we take stances in the market based on the signals that we get from our quant deck. You can get that as a Radar member. To sign up, go to our website at market-radar.com, and you can reach out to us on Twitter at the Market Radar. Thank you guys so much for listening, and have a great weekend.